Headline, though, GDP, much stronger than expected. 4.3, highest read since Q3 of 2023. You know, Josh, I wonder what this does to the thinking on rates. Torsten Slok at Apollo says long-term interest rates will remain higher for longer. Investors should plan accordingly. Deutsche Bank today, ratchet higher for yields is a significant story. I mean, we've been talking about and gaming out and planning for a rate cut in early 26. What if the Fed takes a hawkish tilt? I mean, do investors need to rethink this whole scenario if growth is going to remain stronger than expected, if there's going to be a run it hot idea?
Yeah, look, without a doubt, there are segments of the market that have benefited from the Fed cutting and from this idea that whomever Trump installs next year is going to have a bias toward lower rates, almost no matter what the data is. And as a result, yesterday we were talking about the Dow Transports having unbelievable performance. We've talked on the network about small caps almost endlessly over the last month. And these are all areas where that idea of a little bit of easing and a little bit more accommodative Fed policy, it's important. Like, it matters. It matters not just to the fundamentals of the regional banks, which we talked about, but it matters to sentiment around these sectors as well. It matters to the potential for multiple expansion. And so it is notable. The thing that I would point out, though, is higher rates are a phenomenon around the world. In Japan, they raised rates twice this year, which sounds like nothing, but for Japan, it's a really big deal. They did a 50 basis point rate hike to start the year. And just a week and a half or 2 weeks ago, they did another 25 basis points. And if you look at the 10-year on the Japanese bond, it's gone from 1% to 2% this year. Again, doesn't sound like that big of a deal until I remind you, it's Japan. So we are seeing higher rates around the world. And I think what will be different about this cycle, I'm hoping, absent a financial crisis or another pandemic, there's no reason for investors to believe that we're going to run right back down to 0% interest rates. I know that's people's default setting, given the history of the last 15 years since the great financial crisis. But there is this possibility that intermediate, longer-term rates look something more like 3%, 4% than 0% to 1%. And that's just the world that we're in. I think stocks can become accustomed to that idea. I don't think it's the death knell of the bull market. And frankly, I don't think rates need to go that much lower, just given where economic activity is. So I think we're okay, but I do agree with you, Judge. It's a story.
You know, Steph, rates going up for the right reason, I'm anticipating what I think you were going to say, are still rates going up. And, you know, a Fed with a willingness to run things hot still has the risk of stoking inflation any higher than it is now. I feel like the market today looks at the GDP report and is trying to figure out what it means in the bigger story. Yes, the economy is good by this measure, obviously. Now, there's some trade things in there and what have you. Productivity is having a real impact on growth. So 24% of the S&P in 2023, 23% in 2024. We're clocking 17% gain right now. Who knows what we're going to do over the next and last few days of the year. But how do you put it into context what this all means for the equity market in the new year? Well, I'm going to celebrate stronger than expected growth. You know that about me, right? That's right. 4.3%. We haven't seen that in years. Number one, consumption. 3.5%. The consumer was supposedly dead, Scott. They're not dead at 3.5% personal consumption. Savings at 4.2%. That's better than historic numbers of 2%. You mentioned productivity. You nailed it. Productivity, we haven't seen productivity like this in decades, and that's going to help the inflation story. And it's only going to continue to increase, obviously. Of course. So in a 2% GDP world, let's just say we get back there. I don't see it, but you can grow earnings at 8 to 10%. That's really usually what we do, what we see. We're going to see probably mid-teens, low teens to mid-teens earnings growth in next year, given the momentum that we have. And it is the consumer
And it is AI, but it's not all AI, right? Everyone was saying that, oh, the only reason we're growing is because it's the AI boom. Well, it's also a very important piece of our economy is the consumer, so it's very important to watch that. So I think you're going to have better earnings. So you asked me, are we going to grow 17, 20, 24% next year? I don't really know in the market, but I do think if earnings are too low and earnings get revised higher, the markets will be higher. And my base case is something like 10%. The long-term average is 7.7%. We should be happy with that. But long term, I mean, I feel really good heading in because I think estimates have to move higher.
But long-term rates higher for longer if Slock is correct, and investors should plan accordingly. What does that mean? How should you plan accordingly if you think that rates are going to be higher for longer?
Okay, well, let's put it into context. First of all, the U.S. 10-year Treasury has not been below 3.5% since June of 2023. During that time frame, the S&P is up greater than 60%. So the market can go higher with an elevated U.S. 10-year. I think what's important to think about in the scenario you're describing is where is bond market volatility? Because bond market volatility this year has been very calm. It's been in a benign environment. If you're sharing with me that in 2026, it's going to be in an environment where we have a very wide range for a U.S. 10-year Treasury, that's problematic. And I think ultimately the places that takes you to as an investor is the places where you're most comfortable. You'll probably make the return to large caps over small caps. You probably want to own the Mag 7. You want to stay high up in quality in the financial services. You want to own the big money center banks. So I think that's what's important when you think about where yields are going to go in 2026. What's the volatility that correlates with whatever the price direction is?
What happens if the Fed does take a more hawkish tilt? Like even somebody who's really bullish on the markets consistently, like Tom Lee, is not expecting this incredible year next year, that the first half of the year could be a little bumpy, and maybe you could even dip into a bear market before you pick up. Those are his words, not mine. Yeah. He's the one who is as bullish as anybody, but is suggesting that if the Fed is more hawkish, if rates remain elevated, that maybe some of the great feeling about what's happening is going to be hard to materialize, at least initially, especially if you say, well, maybe the first half of the year, the Fed's in the penalty box. They don't have a new chair yet. We don't know who it's going to be till May. Then you have to wait for a meeting. So you're 6 months into the year. And if you have hot GDP like you do now, with inflation a little bit elevated, they're not going to be so quick to want to cut rates necessarily.
I think that's right. And I think this is perfect timing because it's not time right now to look back. And while the economic data just came in great and it was strong and it was hot, I care a heck of a lot less about those numbers than I do about what I think they'll be in the future. And I'm not sure that they're so predictive. They were hot, and I think everybody knows that there might be some noise and some missed data in them. Not a lot, but a little. So we look forward and we say, do we really think that those numbers will continue at this pace and in that direction? Pace? I don't think so. Direction, maybe. You know, has the market at up 17% year to date? Has it already incorporated all that great news in? You know, what's the leadership of next year going to be? And if Tom's right, you know what you do with that? You take a little risk off the table. And this doesn't mean get bearish. This doesn't mean cash out of your stocks, but maybe you take a little risk off. Maybe if you're 100% in kind of a growthy equity portfolio, like why not take 10%, 5%, 15, whatever makes sense for you? Why not put a little in? Because if you're thinking about this now, you're going to feel pretty badly if Tom's right and there is a short-term bear market coming and you didn't do anything. So I think it's a great time to think forward, to reposition a little.